Hello and welcome to another edition of the Goldman Guide podcast. Hope you're happy with the market these days. We sure are. Our guidance and sentiments have been on point, and our featured stocks are up pretty sharply. Obviously, it's not going to always be that way, but we're happy about it to say the least. We're also happy that our YouTube views have jumped big time from 1,200 2 weeks ago to just under 4,000 last week. So if you haven't subscribed to our channel yet, please do. We're going to have some giveaways soon. Keep that in mind. Now, last week was a real deja vu moment for us. Kind of reminded us of February 2020 when mega caps were rocking, crypto was rocking, meme stocks were all the rage. Everything people touched just turned to gold. You ignored bad news because it didn't really matter. And as we see here, NASDAQ went crazy last week. It's up almost 15% year to date, followed by the Russell. Now, you should know that the S&P 500, while it's doing well under normal circumstances, at least, we think it's going to start to narrow its gap with these two as we near the end of earnings season, while the Dow Jones should continue to lag. One bullish thing I have to mention to you that no one seems to have caught on to is the fact that the price of oil dropped considerably late last week, and it's down 9% year to date. This is a very bullish sign because it's good medicine for everyone's inflation fears and helps people out in the consumer sector, both consumer stocks, emotionally for us, and our wallets. About the only negative I can see right here, right on the edge here in the coming weeks, if the NASDAQ 100 forward PE goes from 25 to 27, I would start to take some money off the table. But aside from that, things are looking pretty good. Okay, now the data here that's most important would be the equity fund flows. We're going to focus on Lipper versus ICI because it's most up to date. And it showed inflows for the first time in weeks. We mentioned a couple weeks ago this was probably going to happen, and to a degree it might be related to the fact that, well, investors have a fear of missing out, right? Even the smallest rally. So they've seen stocks move, and so they decided to put some money back in. Not really much of a surprise. What's also interesting is on the ETF side, the bellwether for the Russell 2000 and the S&P 500 indices, they saw big inflows, but on the outflow side, it was the debt ETFs. These are also bullish signals. The only thing I just want to mention to you about the performance last week before I forget, we had that big move one day last week. There was some short covering that was associated with that. So while we do expect up days, please don't expect those orders of magnitude. All right, you know we love small caps, but big caps are running the stock market these days, and so they attract most money. So let's lift the cover on them, shall we? Well, for a few years, it seemed all we ever heard about were the FAANG stocks, how they rule the economy, they're going to change the world, they dominate stock performance. Talking here about Facebook, Amazon, Apple, Netflix, Google. Of course, that's Alphabet now. Facebook is now Meta, and they lost their teeth last year. Hopefully, you didn't lose much money on these stocks because they dropped by almost 50% on average. This year, it's been pretty good so far. Let's see what that's all about. All right, they did regain some bite, as you can see, especially Meta, which had that huge performance last week. But all these guys are up pretty well, on average, about 28%. That said, they still have not reached levels that we saw early January of last year. So as you can see, the performance, has returned, but look at this, still down an average of 33% from the level on January 3rd, 2022. Even Facebook or Meta down 45% from that level. What's interesting, however, is with the big gains this year, you'd be surprised that the valuations really are not too crazy. They're not that high. So if we had to choose to buy one of these, what would we be inclined to buy and why? Well, we put together some data here and a few very interesting things. First of all, the calendar year price to sales ratio on average is 4.2 for the group and 23.6 average price to earnings ratio for the calendar year. It's not so high. PEG ratio of 1.15. This is all pretty average. So the valuations really are pretty good, and we're seeing some pretty decent growth rates from the sales perspective as well as PE, as you can see here. So with that said, what would we choose? Since there are a couple FAANGs that are showing some teeth here. It would have to be Meta. It would have to be Amazon. I don't like the Meta business model, I have to admit, but you got to love 4 times sales, 16.5 PE, low peg. Amazon, higher growth rate, ridiculously low price to sales. Big increase in EPS this coming year. And of course, everybody buys from Amazon, right? We're really not going to be stopping that much, right? Especially Amazon Prime. So I like that better than Meta, but these would be the two that I would choose. So with that said, just a couple of interesting points for you. Before we step into the featured stock, let you know that our pick 2 weeks ago, INSE, which is a gaming or gambling play, is up sharply, and we think that we can see it rise again this week. Why? Investors are probably going to take more risks than usual after last week and the fear of missing out factor. And also, more money is likely to be wagered this week and next weekend than any other time of the year because it's the Super Bowl. So, with that in mind, today's featured stock is a real flyer. Crashed in December, doesn't look great, but it could have a good week or not. But if you have a good holding period on this thing, it could be a real sleeper. So our features Vanda Pharmaceutical, ticker VNDA. It's a biotech generating nice sales, nice profit, has a huge clinical pipeline from early clinical phases all the way up to many in late stage phases. And we're talking about multiple drugs with multiple indications. There's a boatload of value here. Just a quick review of the stats. You'll see the stock closed in the mid-range of its 52-week trading, has a $432 million market cap, 650,000 shares traded, and the net cash per share is only $5.28. That means that the cash and cash equivalents minus all the debt leaves you with $5.28. So you're paying only $2.50 a share for a business generating hundreds of millions in sales and profit. It's amazing. Book value of $9.11. There's great value here, no doubt about it. And even on the technical side, worst case, it's neutral. Now, there are two drugs generating sales here, Hetlioz and Fanapt. Okay, pardon my mispronouncing them. Hetlioz is approved for sleep disorder, Fanapt for schizophrenia, and these two drugs alone have multiple indications, including 2 in phase 3 for Hetlioz and 1 in phase 3 for Fanapt. So you can see this big-ass pipeline here. You've got 8 in phase 3 already. So you can see why we like it from the clinical and financial/valuation perspective. But hold your breath, because here's the problem. The stock fell off a cliff at the end of the year as a court granted, and now there's a stay, of a generic version of Hetlioz to be sold by some players. So considering it accounts for like half of sales, could place a big hurt on the stock, and that's why it cratered. Now, I believe that all that news is already reflected in it. And even if the generics start selling, it's going to have an impact, but it's not going to completely crush the company. They've got all these other drugs in clinical trials, various stages. There's going to be a tremendous amount of news flow. And you have one of the company's products, Fanapt, they already have sales, and that's probably going to see some good growth this year as well. So the key is that when they announce their results on Wednesday, February 8th, we can start to see the stock position to move a bit better if we have some good guidance, especially on the legal front. If not, we could see a drop. If it does drop, I probably would sell, but put it on my watch list. And if it doesn't, it could be a good run valuation-wise. And even if that happens, haircuts to forecasts occur, the thing is cheap fundamentally on a price-to-sales ratio, or price-to-earnings, and that net cash per share that we mentioned. And technically, if it starts to have momentum, it could really run. I think this is a double this year or more. Now, this is not a recommendation. It's all for informational purposes only. All right. Well, that will do it for this week. Thanks for listening. Can't believe we made it in less than 10 minutes. I tried to push it through for you because we had a whole lot of important things to talk about. But have a great week. Thanks again.